Well, let's talk about, before you present some of your slides, but let's talk about your career and shift to that. Where'd you grow up? I forget.
I grew up in a small town, 3 small towns in South Jersey till I was 9, and then I moved to Richmond, Virginia when I was 9. I was there till I was 18.
And what did you study in college, and what were your early career aspirations? You didn't always want to be an investor.
I was an English major my first 2 years, and I wanted to be an English professor. My first semester of my junior year, I took a course in economics so I could read the newspaper, because I wasn't very good at it, even though I was supposedly an English major. And fell in love with the subject and crammed an economics major in. I think I took 18 out of my last 21 courses were economic courses, something absurd like that. And then I wanted to be an economics professor. So I wanted to teach. I love teaching.
So yeah, you have teaching in your genes, it sounds like, at least it called early. What?
Well, I also have a dropout in my genes, because I went to get my PhD in economics at Michigan, and I lasted a semester and a half. I didn't handle them as well as you guys handled them on the football field back then. Anyway, I lasted a semester and a half, and I dropped out, went to work construction for 6 months, and then my first marriage, which was a practice marriage, in at 22. In at 22, out at 23. Don't get married at 22, okay? It was my first great cutting my losses, okay? Oh, actually, she cut them, not me.
We have her here.
Anyway, she lived in Pittsburgh, and she was more connected than I was, and I got a job at Pittsburgh National Bank through her stepfather.
And for those who aren't in the financial services industry, can you explain what exactly a hedge fund manager does, and how is that different than a traditional money manager, in simple terms?
I have no clue. Hedge fund has become the wildest term out there under the most gigantic umbrella, but I think the original concept was you borrowed, you were able to borrow money, so you didn't just, if you had $100, you might invest 120 or 130 of it by borrowing, and your fees were a percentage of the profits you made for your client. Pre-hedge fund, you would just charge 1% of whatever the client gave you. Under the hedge fund format, there's really the only 2 things they have in common is they generally use leverage, and they generally charge the client as a percentage of profits. Okay.
And you started your company, Duquesne Capital, in 1981, I believe. When you started your company, so, shift back a bit, how old were you when you started your first fund, and how much did you raise?
Well, I was 28 years old. When I was 27, I was Director of Investments for Pittsburgh National Bank. I was running $6 billion, and I was doing a pretty good job because the Shah of Iran went under, and I had no experience whatsoever, so I said, this is easy, let's put all our money in oil stocks and defense stocks. If I had been a little older and a little wiser, I would have diversified. It went up a lot, so everybody thought I was a genius. I wasn't a genius, I just didn't know any better. So I go to this dinner in New York. I'm making $43,000 a year, and I give a presentation on the gold, and the guy says, you don't sound like you're from a bank. Why don't you start a firm? And I said, with what? I'm worth about $4 grand. And he says, well, I'll pay you $10,000 a month to talk to you. So I started Duquesne Capital, and he said, you can raise money. Well, I'm such a good salesman, after a year and a half, I'd raised $900,000. So that's what I started with, $900,000. 2 years later, the guy that paid me $10,000 a month to talk to me, I woke up one morning, and he was going to jail. He had some scheme, and it cost Chase Bank $256 million. By then, I was up to a grand total of $7 million with a 1% fee. For those of you who went to the wrong school, I know all USC people can do the math. I had $70,000 a year in revenues, and my overhead was $160, and I was in deep, you know what. So that's how it started.
So started small. You started small, but still you started young at 28 years old. To raise $1 million is no easy feat. In the introduction, I did say at the time you retired in 2010, your firm was managing $12 billion, so the growth was pretty stratospheric. Give us a couple quick answers just to educate us. What is a typical annual return for a hedge fund these days? Like, what's a good hedge fund return?
Today?
Yeah.
I'd say people are pretty happy and pretty proud. I'd say 12%.
12%.
12% a year.
12% a year. So over the course of 30 years that you ran your fund, what was your average annual return?
30.4, but who's counting?
And you know, they're up and downs, particularly in hedge funds, because you make big bets. How many down years?
0.
Zero. 0 down years. So if you have the same question that I had, which is, have you invented a time machine yet, and can we go back and invest in your fund? The answer is no, unfortunately. You must have made a lot of people a lot of money, and you know, applying these same things. So talk about your investment philosophy and why, you know, you got those types of results. How did you do it?
Well, my idea of risk control is a little non-conventional. I like putting all my eggs in one basket and then watching the basket very carefully. I think, I don't know what they teach at Marshall, but at most business schools they teach, I think, a lot of nonsense called risk-adjusted return and diversification. Ouch. As a money manager, if you look at a normal portfolio, most people will make 70–80% of money that year on 2 or 3 ideas, even though they'll have 30 or 40 things in their portfolio. My concept was to put into those 2 or 3 ideas that I had the most conviction in. I was also lucky to travel across asset classes, so I traded commodities, currencies, bonds, and equities, and it gave me the discipline. If I didn't have a good idea in equities, I was happy to have no equities, or the same thing with bonds. So when you have a quiver with a bunch of arrows in it, you can usually find something to put a lot of money into. The only other thing I'd say is too many investors look at the present. The present is already in the price. You have to think out of the box and sort of visualize 18 to 24 months from now what the world is going to be and what securities might trade at. You know, what a company's been earning is ridiculous. It doesn't mean anything. What you have to look at is what people think, what a company's earning, what people think it's going to earn, and if you can see something 2 years that's going to be entirely different than the conventional wisdom, that's how you make money. My first boss used to say the obvious is obviously wrong. If you invest in conventional wisdom, you're going to lose your butt.
Because everyone's already there. Let's talk quickly about philanthropy, and then we're going to go to your slides. In 2008, you had a big year publicly. It was reported that you made $250 million. In 2009, you were listed as the most charitable person in the United States, giving away $700 million to foundations supporting medical research, education, and anti-poverty. Why do you give, and how do you decide where to invest your philanthropic and service dollars?
Well, the first reason I give is because I can. I don't know where it came from. I was given a gift. I'm good with compounding money. I'm a competitive person. I got an ego problem. I like winning. I like beating somebody at something, but it really doesn't give you that much satisfaction. It is a great irony to me that my wife and I get honored when we go places for giving and people think you're nice people. I don't do it to be a nice person. First of all, it's a privilege and it's fun when you have this much money and there's so many things out there to be able to give it and shape things and direct things. I mean, it is really a source of great pleasure and satisfaction. And, you know, to be able to meet people like Jeff, and he's in the trenches. I mean, what he does compared to I do, it's not even close, but to be able to fund them and maybe make a difference through their efforts and still what I do for a living, because I love what I do. You know, I do it because it's fun, to tell you the truth, and you can make a difference.
And what could be a better life than doing well? And I mean, why wait till you're gone to give money? I mean, to see it at work during your lifetime, It's just a great way to
I don't
live.
get it. There's statements out there about guys being greedy or whatever who don't give money away. And I don't really look at that. I think they're stupid. I mean, they have no idea the joy they're missing. And you take a guy like Buffett, who is revered around the world, good for him. The man never gave away a penny until he was 70 years old, and then he hands it all over to Gates to do. The fun of it is getting in there and watching these great people like Jeff Canada operate and sourcing them and working with them. Just to write a check is not what it's about.